What if I told you that the world's wealth could disappear in a matter of days? A chilling thought, isn't it? Yet the stock market, with its volatile temperament, has proven this to be a reality on more occasions than one might care to remember. The concept of stock market crashes, while complex and multifaceted, is an integral part of our financial history. Picture this. It's the roaring 20s. The economy is booming, and the stock market is the playground of the rich and hopeful. But all that glitters is not gold, and beneath the surface the market was far from stable. This was the setting for one of the most devastating financial events in history, the Wall Street crash of 1929. The stock market, like any market, thrives on the balance of supply and demand. But what happens when that balance is upset? When speculation drives prices to unfathomable heights, only for reality to pull the rug from under investors' feet? That's when a crash occurs. And in 1929, that's precisely what happened. Investors, entranced by the allure of easy wealth, bought shares on a massive scale, inflating their value far beyond their real worth. The bubble grew until October 24th, when it finally burst. Panic ensued as investors rushed to sell their overvalued shares, causing prices to plummet and the market to crash. The aftermath was catastrophic. Billions of dollars were wiped out in a matter of days, and the shockwaves were felt across the globe. Businesses collapsed, unemployment soared, and millions of people were plunged into poverty. The world's wealth didn't just disappear, it evaporated. The Wall Street crash of 1929 marked the beginning of the Great Depression, a decade that still haunts the financial world today. It serves as a stark reminder of the perilous plunge that can follow unchecked speculation and the devastating consequences it can have. The lessons learned from this event are invaluable, offering us insights into the volatile nature of the stock market and the importance of financial prudence. Fast forward to 1997, when the world watched as Asia's tiger economies fell one by one. The Asian financial crisis was a stark reminder of how quickly fortunes can change. It began in Thailand, a country that had been enjoying rapid growth, buoyed by an influx of foreign capital and speculative real estate investments. But the bubble burst when the Thai government, burdened by a massive financial deficit, was forced to float its currency, the baht. Like a row of dominoes, the crisis quickly spread across Asia, from South Korea to Indonesia, Malaysia, and the Philippines. These tiger economies, once roaring with growth, were suddenly mired in severe financial turmoil. Banks collapsed, currencies plummeted, and stock markets crashed. The crisis wasn't confined to Asia, though. It sent shockwaves around the globe, impacting economies as far afield as Russia and Brazil. In the aftermath, the International Monetary Fund stepped in, providing bailout packages to the affected countries. But these came with stringent conditions, including deep cuts to public spending. The social and political fallout was immense, sparking protests and toppling governments. But what lessons did this crisis teach us? Firstly, it underscored the dangers of unchecked speculative investment and the need for robust financial regulation. The crisis also highlighted the risks of rapid liberalization without adequate safeguards. In particular, it drew attention to the moral hazard of lending without due diligence, a lesson that would be echoed in the subsequent global financial crisis. But perhaps the most significant lesson was about our interconnected world. The Asian financial crisis laid bare the interdependence of global economies. It showed how economic turbulence in one part of the world could ripple out, causing disruptions far beyond its epicenter. This realization sparked a new era of international cooperation in financial regulation and crisis management. The Asian financial crisis taught us that no economy is an island and that global markets are intricately connected. Understanding this interconnectedness is crucial as we navigate the financial challenges of the 21st century. Turn the clock to the dawn of the 21st century, an era of innovation, technology, and a bubble that was about to burst. In the late 90s, a new frontier was opening up. The internet, once a novelty, was rapidly becoming a necessity. This digital revolution was leading us into a new era, and with it, the birth of internet-based companies, or what we now know as .coms. Everyone wanted a piece of the action, creating a frenzy of investments. But as the calendar flipped over to the year 2000, a harsh reality began to dawn. Venture capitalists were pouring money into these .coms, often disregarding traditional metrics of success, like profitability or revenue. The promise of future profits was enough to fuel the fire of speculation. Share prices of these internet companies were skyrocketing, creating an overvaluation that was unsustainable. The bubble was growing, and it was only a matter of time before it burst. And burst it did. In early 2000, the technology-dominated Nasdaq Composite Index peaked, and then it began a rapid descent. Investors started realizing that these dot-coms were not going to deliver on their profit promises. Panic ensued, leading to a massive sell-off. By the end of the year, many of these dot-coms had gone out of business, their high-flying stocks now worthless. The aftermath was severe. Trillions of dollars of wealth were wiped out. Investors were left licking their wounds. Their dreams of quick riches turned to nightmares. But in the wreckage, there were lessons to be learned. The dot-com bubble burst served as a wake-up call, a stark reminder of the dangers of speculation and overvaluation. It taught us the importance of due diligence and a return to basics, that a company's value should be based on its fundamentals, not hype or speculation. It was a lesson in humility, a reminder that what goes up must come down. The dot-com bubble burst was a stark reminder that speculation and overvaluation can lead to ruin. A lesson we must never forget. 2008, a year that will forever be etched in the annals of financial history. This was the year when the world witnessed a financial crisis of epic proportions, the global financial crisis. An economic maelstrom that had its genesis in the heart of the United States, it soon spread globally, leaving no corner of the world untouched by its devastating effects. The root of this crisis lay in the U.S. housing market, specifically in the realm of subprime mortgages. Financial institutions were selling off these high-risk loans to investors worldwide, repackaged as sophisticated financial products. The premise was simple: lend money to homebuyers with poor credit, then sell these loans to investors who were hungry for high returns. But when the housing bubble burst, this house of cards came tumbling down. This led to a domino effect. Banks worldwide, burdened with bad debts and facing a liquidity crunch, started collapsing. The stock markets plunged and millions of jobs were lost. The world stood at the precipice of a global recession. But with every crisis comes valuable lessons, and the global financial crisis was no different. It taught us the importance of risk management. Banks and financial institutions had to reassess their risk-taking behaviors, leading to a more cautious approach towards lending and investing. The crisis also underscored the need for transparency. The complexity and opacity of the financial products that were at the heart of the crisis were a significant contributing factor. In response, regulators worldwide have since pushed for greater transparency in financial transactions and the disclosure of risks. Finally, it highlighted the importance of fiscal responsibility. Governments, financial institutions, and individuals alike were reminded of the perils of living beyond one's means. The crisis served as a stark reminder that unchecked borrowing and spending could have catastrophic consequences. The 2008 global financial crisis was a wake-up call to the world, a stark reminder of the potential devastation of unchecked risk and financial irresponsibility. It taught us that the pursuit of wealth without regard to risk, transparency, and fiscal responsibility can lead to disaster. And that's a lesson we must never forget. From Wall Street in 1929 to the global stage in 2008, stock market crashes have shaped our financial landscape. Each of these seismic events, from the perilous plunge of the Great Depression to the Asian financial crisis, the dot-com bubble burst, and the global financial crisis, have offered us invaluable insights. We've learned that unchecked speculation, excessive borrowing, and financial illiteracy can lead to devastating crashes. We've also seen how resilient markets can be, bouncing back even from the deepest of falls. These lessons underscore the importance of financial literacy. A clear understanding of how markets function allows us to make informed decisions and to weather the storm of economic downturns. As we journey through financial history, we see that each crash, each crisis, holds valuable lessons. Lessons we must remember as we navigate the ever-changing tides of the global financial market.